Most investors miss out on DSCR loans, not because they don't qualify, but because they believe myths that just aren't true. There's a ton of confusion around DSCR loans. What are they, who qualifies, and how they work. Today, I'm clearing it all up. So if you're relying on outdated or worse, secondhand information, you could be leaving deals on the table or structuring your application the wrong way. I'm Andrew Russell, owner and founder of RCG Mortgage, and I specialize in the DSCR mortgage. I've worked with thousands of clients who've received them, and we help them gain real estate riches through the best investment product ever, the DSCR. I just had a seasoned investor find me, actually off of one of the YouTube videos that I actually posted, and he was prepared to buy another investment property and put 50% down. He went to his local bank. He was getting horrible misinformation, and they told him that for anything moving forward from an investment purchase, for no income check, at least that's what they called it, it was 50% down. Now, he didn't really believe it. He saw one of the videos, believe it or not, that we posted, and he reached out. And it turns out that it was just a local bank crazy overlay, that they require something that's just not necessary in the secondary market. So 20% down, he was looking to buy, I believe, a duplex, a two-family, a legal two-family. 20% down was actually the minimum on this specific two-family purchase. So we were able to do 20% down for him instead of the 50%. So as you can kind of figure out the math, it was $1 million purchase, two-family home, and that saved him $300,000 of capital. So not only could he buy the first one, he was able to buy a second and almost a third just because he got the right mortgage product. And again, 20% down, we checked the market rent versus the actual mortgage payment. It cash flowed because we had 2 units in rent, each unit when you add it together for the DSCR mortgage, as long as that covers the mortgage, just to keep it really simple, guys. Then you qualify for the mortgage. So he actually qualified and was just getting bad information. Thank God for YouTube. Shout out to YouTube. But of course, everyone always brings up, hey, Andrew, I'm sure you're 20% down versus 50% down versus a conventional loan. The interest rate is just so much higher. It's almost predatory, right? Wrong. Interest rates on DSCR loans are almost right there with a conventional mortgage. So for instance, for argument's sake, guys, a 30-year fixed conventional mortgage rate is 6.5. The DSCR maybe 6.75, 6.875, maybe 7.25. It's not all that much different. But what it does is, which we're going to talk about in a little bit, it opens up the opportunity for more and more purchases to increase your real estate wealth, to not be kind of either pigeonholed into one purchase or just getting bad information from a bad lender. And of course, hey, Andrew, no income check investment purchase? Isn't this exactly what happened in the crash? No, a crash will not come because of the DSCR mortgage. I can promise you that, guys. Why? Because during the crash, you had little down payment options, no money down, believe it or not, for investment purchases. People took adjustable rate mortgages, and these programs are 30-year fixed, which is very safe. So all the predatory, dangerous features of no money down, so you had no equity. So if the equity goes down a little bit because of the market, why would you pay your mortgage, right? When you have no equity, that was the psychology behind people not paying their mortgage. On an adjustable rate mortgage, if the interest rate adjusts, and then all of a sudden your payment goes up, again, none of this stuff is existing currently in a DSCR suite of products, which is super cool. And of course, hey, Andrew, what's the catch? Something must be wrong here. You're pulling the wool over our eyes. It must be illegal, right? No, it just has to do with there are a multitude of mortgages, guys. It's FHA, VA, USDA, rehab loans, 203K, conventional, Fannie Mae, Freddie Mac. There's so many mortgage types, portfolio. This is just a non-QM macro mortgage product type, right? Specifically the DSCR loan. And there's just basic guidelines. There's a bunch of non-depository institutions offering these, meaning you don't walk into a big bank where all your money's at. Typically, these aren't the places that offer them. They're huge, multi-million, if not billion-dollar companies that offer these, but they all make their own rules. And the rules are typically, as long as you're either, and even now, again, I take a step back, they allow first-time investors or first-time buyers to do these with certain caveats, as long as you put down typically 15 or 20% down or more, ideally 20%, and the market rent will cover that mortgage, you qualify all day long. All right, guys, I think it's best if right now we go over the FAQs, the most frequently asked questions about these DSCR loans, because if they're frequently asked, I'm sure all you guys watching this are going to kind of be curious, and it'll pique your interest on some of these items, if the DSCR loan's for you, or just in general, what is the DSCR loan all about? But before we do this, make sure you click the link below, hop in our description, make sure you get our DSCR mortgage cheat sheet guide. It's going to show you a multitude of options for DSCR loans, all the different lender, product offerings. Make sure in the description, guys, make sure you click the link, make sure you get that guide. I spent a lot of time making it for you guys, but make sure you get it. It's going to have a complete overview of what we're talking about, and it's super important. All right, so typically the first thing that's always asked is, hey, Andrew, what's better, a conventional mortgage or a DSCR loan for investors? Now, this is kind of a loaded question for a few reasons. Number one, conventional loans, you cannot buy or put the mortgage in a LLC or corporation's name. Now, why do people do that on an investment? When you're getting an investment property, you have a tenant. What happens if that tenant hurts themselves or something happens and they sue you? On a conventional mortgage, if you buy in your personal name, the tenant is going to sue you personally, which is never good. So it's always rule of thumb. Ideally, any investment property you have, you want title or the deed to be in an LLC or a corporation, just so you're covered. They can't pierce the corporate veil, I guess is the term. But conventional loans, typically whether 20, 25, 30% down, they do have a little bit better of an interest rate, number one. We're going to talk about a little bit of prepayment penalty. They don't have prepayment penalties where DSCR loans do, or you can buy out the prepay by getting a higher rate. So there's a couple different caveats there. But a conventional loan looks at your income and qualifies you in a different way versus a DSCR loan. They're going to look at your actual current expenses versus what you make. The new property, the way they calculate rent, typically they take 75% of the rent, not 100% of it. They use a 25% vacancy factor. So a lot of caveats. So can we, as mortgage professionals, say a conventional loan's better or worse? It depends on what you're looking for. But the rule of thumb, typically, the DSCR is the go-to, even if conventional has a slightly better rate, even if it's putting title in an LLC or corp to save you from any potential lawsuits or legal issues, right? A second question, typically, what's the minimum credit score for a DSCR loan versus a conventional mortgage? So DSCR loans, we actually just had a rep from a huge company in our office yesterday, and she was telling us they actually now go down to a 600. That's right, a 600. And it was a big overlay because our company actually allowed a 595. Oh my God, they raised the credit requirement 5.600s. But it's crazy to think you can buy an investment property. Now, granted, the down payment's probably going to be going up just a little bit on a 600. You're not getting away with a 20% down purchase with a 600 credit score. But even so, whatever happened on your credit, you can still purchase a DSCR loan with a credit score down to even a 600, which is crazy. On a conventional loan, 620 is always the minimum for a conventional mortgage, but there's also an automated approval system. It's really hard to get an automated approval if your credit score and investment purchase is or investment refi is under 680, 700. So depending on where your credit falls, the DSCR loan may be the best for you just because that wide credit box and that wide flexibility. Now, make no mistake, just because you have a 600 credit score, they check the profile. Are you paying your debts on time? Do you have other mortgages? Do you have other mortgage lates under those mortgages? So sometimes a score, maybe you have high balances versus your charge cards, your credit cards. So there's acceptable reasons why your score is where it is, but it doesn't mean the credit profile, how you pay things, can be bad in and of itself either. A third super common question, hey Andrew, I don't get it, broski. Do I have to show my tax returns and W-2s? No. It's literally that simple. So think of a pre-approval for a DSCR loan. Hey, Andrew, I'm interested in getting pre-approved. Cool. How long until you're looking to purchase? I ask because if it's in the next couple months, we'll do a hard pull. If not, we'll do a soft pull. Soft pull on the credit report side means that it doesn't have a hard inquiry. So if you don't find a property in the first couple months and you find it in 6 or 12 months, it doesn't affect your credit scores. We had so many hard pulls. We look at the credit, and then from there we ask a couple questions, and that's it. It's a no income check. We don't ask for any tax returns, W-2s, pay stubs, 1099s, none of that stuff. It's, hey, what are you looking to buy? 123 RCG Way. How many family houses? It's a 2-family. Awesome. Can you put 20% down? Yes. What's the mortgage payment? Let's say it's $6,000 all in. Cool. What's the market rent for each unit? $3,500 each unit is what the realtor is telling us. Awesome. Maybe, me, meaning Andrew, have a conversation with the realtor to make sure the guy's not, blowing smoke at us, because that's what it's based off for the pre-approval. But $3,500 a unit times 2 is $7,000. If you remember, the mortgage payment was $6,000. So there you go. You're pre-approved for that purchase. We did the credit. We took a look at the credit profile and ran their credit, but that's all it takes on that end. Now you have your offer accepted and you go into contract. What do we need from there forward? It's the same thing. We need 2 months bank statements so we can see the monies. Obviously, to finish out the purchase and have enough money potentially for reserves. These are typically things that we ask for a pre-approval as well, depending on the circumstance. But from there, you get an appraisal, you get a title, You review some of the things that the underwriter might ask for, like a letter of explanation for maybe a late, or some things here and there, maybe an alternate address on your credit report. But ultimately, it's a very reduced documentation type program. Again, no W-2s, no pay stubs, no tax returns. But also, if the corporation or LLC is going to go into title, they'll ask for corp docs, right? EINs and articles of this and all sorts of cool stuff that's a little bit above my pay grade. But those are the typical items that they ask for, but it's way more reduced versus the typical vanilla purchase. Say typical vanilla, two teachers buying first-time home buyers buying, a one-family house, putting 20% down. They may send in more paperwork than a DSCR mortgage purchaser. What's my minimum down payment? This is a super popular FAQ. Now on DSCR, there are firms that allow a 15% down payment. Now 15% or 85% financing versus 20% down and 80% financing, in Andrew terms, the rate's a little spicy, guys. So instead of putting 15% down, getting a horrific interest rate, or paying more in points or additional closing costs, to me, it makes more sense to put down 20%, get the better rate, because you're saving the additional cost. Say the additional cost is 3%. So that means that 5%, you're paying an extra 3%. So that 2% differential, if you just put down the 20%, although it's 5% all in, you're still removing 3% of that cost. So again, if you're doing 15% down, but with that, the closing costs are horrific, right? It's more risk, so there's an extra 3% in actual closing costs. If you put down 20%, maybe you remove that 3%. So that extra 2%, number one, you get a better interest rate, and number two, the 3% in actual cost, you don't have that. You're completely burning money. At least by putting that additional monies down, you get that additional equity. All right, so we're on to the next page of exciting FAQs, which is, of course, why do DSCR loans, Andrew, have higher interest rates? Now, of course, guys, the rubber has to meet the road somewhere. If you're not showing any documentation, it's just going off market rent, you don't even need a tenant in place when you close. There's going to be some risk-based pricing built into the rate. So if the going market rate is 6.5 for a vanilla two-teacher, 30% down, 780 credit score purchase, the DSCR purchase might be up to a 6.75, 7.25, 7.5%. Why? There has to be a margin baked in because lenders need to make a little bit more on those in the secondary market because God forbid those default. Now, technically, you would think that would default at a higher rate than two teachers putting a lot of money down, but the higher the rate, usually you're building in a little bit of risk. These loans do have more risk. Why? You're looking at credit, and the credit profile is great. You're putting a good amount of money down, so the equity position is great, but you're not really showing any type of income. So because there's a little bit of risk built into it, vis-a-vis a higher rate, so lenders have a little bit more money, a little bit more cushion. God forbid something happens. Can I use a DSCR loan on a property that's not rented yet? Yes. If you purchase a property and there's no tenant inside it, it's going off the market rent. That's crazy to think, but whatever the market rent is for that one family, 2 to 4 family condo, that's what we're going to use to qualify you. And it's based on what the appraiser says, their opinion of market rent is. Even on a refinance, there are ways, if it's a vacant property, to still use market rent. Makes it a little bit more difficult, a little bit more guidelines than what I'm saying, it's a little bit more into it, but it doesn't have to be rented before you close. It might make sense that if you buy a property that's a $6,000 monthly mortgage payment before you close and it's a 2-family, you want to get those renters in there, right? Your biological clock's ticking like this. You want to get those renters in there as fast as possible. Otherwise, you're going to be stuck paying it. But just remember, guys, if you close in July, August, you're off. Your first payment's in September. So if you close in July, you really have, 1 to 2-ish months to get that renter in place. So when you rent a property, right? So if you rent, typically July 1st, your rent's due for the month of July. If you close in July, August, you're off. Your first payment's in September, which is for August interest. So it's the preceding, not proceeding. So because of that, there is some flexibility in timing, but you definitely want to get a renter in there sooner than later. Can I use a DSCR for Airbnb type income? The answer is yes. Short-term rentals, Airbnb, it's all allowed. But every second, every week, every month, guidelines on this change. I can tell you with 100% accuracy that whatever the market rent is, as long as that covers, you're good. I can tell you with some certainty that Airbnb now is accepted. Doesn't mean it's accepted tomorrow or in 6 months. Maybe it might be illegal Airbnb income. But right now, the market rent is typically the number one thing that's used. Now, just remember, you don't have to have a 1-to-1 ratio, meaning the rent doesn't have to fully cover. There are options where if the rent covers 75 or 80% of the mortgage or down to 50% of the mortgage, or even you don't use any rent at all, that you still can qualify. So what's the catch? The interest rate goes up. So in other words, If the mortgage payment is $6,000 and say the rent is $4,800, that covers 80% of the mortgage. Instead of a rate of 6.75, maybe a rate 7%. Now, if the mortgage payment is $6,000, say the rent's $3,000, which would be pretty wild. There's got to be a reason. But say the investor wants to still purchase it. Maybe your rate is 7.5%. Now, if you don't want to show anything at all, number one, the down payment might be higher. Number two, your rate might go into the 8s or 9s. So there's a bunch of different options, but it doesn't mean that it has to be on a 1-to-1 ratio specifically. God forbid the Airbnb thing isn't allowed. There's still other options. Are there more upfront costs? Yes and no. I mean, typically DSCR loans will have, let's just say, an additional 1 to 2% in cost, depending on what rate you choose, if you're paying discount points or some sort of an origination fee. So there's usually a little bit more in cost. I would speculate whatever your loan size is, conventional versus DSCR, there's typically about another 1% of that loan amount, all in cost. So a $800,000 loan, it might be $8,000 more in closing costs. Now, is it allowed for a first-time buyer? This is literally all over the map, depending on the lender you work with. That's the benefit of working with a broker. We have access to all the DSCR lenders to put maybe even a first-time investor, a first-time buyer, with a lender that allows it. So we have lenders that do allow it, a first-time buyer, a first-time investor, but it has to make sense. Just remember, guys, the biggest forms of fraud right now are occupancy fraud, meaning, are you buying saying you're going to move in and you don't? Or are you buying saying you're not going to move in and you do? So investment, the fraud would be you're buying it as an investment and you actually move in. So they're qualifying you on market rent, but you moved in. So how are you going to pay it, right? So if you're a first-time buyer and a first-time investor, it's like, why would you buy yourself an investment property? Wouldn't you be moving in? Are you going to live at home forever and live the dream? But there are certain instances where it's actually allowed, but typically they want to see that you bought a property first, without a doubt. So can the down payment be a gift? Now, they do allow it. In certain instances, you can have a 100% gift or a partial gift. Again, it's specific to the lender. But these programs do allow monies to come from someone that is not you. Now, conventional loan doesn't allow that. Conventional loan does not allow gift specifically. So this is one of the key features. Is there interest only as a payment option? Yes. If you're 100% sure that your loan, you're going to either refi or whatever, like typically these interest-only programs have some form of a balloon or it turns into a 20 or a 15-year fix after the interest-only period's over. So it's risky, but you do save per month if you just do an interest-only payment. It's not for me and my, risk appetite. I'll let you guys know, but interest-only is something that's available. So minimum loan amounts. There's not really a minimum loan amount. I mean, once you get under $50,000 to $80,000, it's a little bit dicey with lenders allowing it. But typically, there's not a specific minimum loan amount that lenders will kind of want you to work with them. Just remember, they might have a minimum loan because it costs the lender the same amount of money to procure a loan, whether your loan's $1 million, $100,000, $500,000, $50,000. The same amount of people have to do the same amount of stuff. And they cost fixed cost salaries. So typically lenders will want a minimum loan. Otherwise, they're fixed cost employees and we're working on something that doesn't really generate a lot of revenue. But there really isn't a minimum loan per se. There are reserve requirements. Reserves are, say the mortgage payment again is $6,000. If you close and you have $20,000 to your name, you have 3 months reserves, meaning $20,000 is a little bit more than 3 months of your mortgage payment. So on these programs, lenders always want to see you have money left over for a rainy day, right? It could be 3 months, 6 months, 12 months. So before you get pre-approved, you should say, hey, I'm just curious, the reserve requirement, meaning how many months of this payment do you want in the bank after we close, after I pay closing costs, because they are required. So just make sure you know, so your pre-approval isn't no bueno, right? That it's not only as good as a piece of paper that it's on, because reserves are definitely a big thing. And last, the most important to bring up, you will see DSCR loans have prepayment penalties sometimes. So they didn't before. Depending on the state, there usually was none. And it was either, a good interest rate or the higher closing costs, as we said, but then they introduce a 1, 2, 3, 4, or 5-year prepayment penalty. Now, typically, the 1, the 3, and the 5 are the most common. Now, why, Andrew? Why would I ever want a prepayment penalty? Because if you do a 5-year prepayment penalty and now again, you're allowed to sell, you're allowed to refinance, you're allowed to pay it off. There's nothing that gets in your way. There's just a financial cost to it. So if you do a 5-year, you're telling that lender and that team, hey, I will keep this loan for at least the first 5 years. Now, what's in the first 5 to 7 years? All the interest, guys. So you're saying, listen, I'm cool with holding this loan. So you guys make whatever you have to make. So in return, that lender will give you a far better interest rate than if you did a 0-year or no prepayment penalty. Now, You just have to ask yourself, am I buying this? Am I going to hold it? Am I ever going to refi it? You know, 3 years, probably a safe number, but just understand a prepayment penalty doesn't stop you from refining or selling. It gives you better pricing, but if you do refi or sell before that 5 years, if you opted for a 5-year, there is a bit of a financial penalty. Typically, it's up to 5% of the loan size, so it's a good chunk. I know we talked about a lot of stuff, guys, but make sure you click in the description, click the link, and get that DSCR guide. It's a free guide that your boy made, going over all the different specifics about what we just talked about, because again, it gets so convoluted. I geek out on this stuff. You may not, but you might be an investor or a new investor kind of popping into the real estate market, and you want everything we just said in a quick and easy, understandable guide. Make sure you click the link and download the free guide. If this helped to clear things up, guys, make sure you watch our next video, DSCR Loans Explained for 2025, Mortgages for Investors. It's going to show you in 2025 what's changed, what are some of the cool new things that we can do with these loans, what has gotten a little bit worse, a little bit more difficult. So make sure you watch this video, guys. Click this video. It's awesome.